guys, and today's video is going to be fairly brief. We're going to be covering standard deviations and how we can use them to pick targets, right? So in order to have the settings, you're going to want to go over to your Fibonacci tool, which you can find here, Fib retracement, right? You're going to want to double click to go to the settings, and here are the settings that you can copy over. It's 1, 0, -1, -2, -2.5, and -4, right? So for intermediate term trades, you can use targets relevant to 2 to 2.5. So here, if we were looking to scalp this market, we can target liquidity resting here between 2 to 2.5 approximately, right? And for a longer term trade, we can target liquidity which is external, which is relevant to 4 standard deviations, which is right over here. And as you can see, we quite accurately tick 4 standard deviations. And keep in mind, we're anchoring our Fibonacci from the long-term low to the intermediate-term high. A quick tool to do this is fractals, right? You can see where the highs and lows rest, so you can anchor your Fibonacci tool, right? Once again, we see a market structure shift here, so right away we can pull out our Fibonacci tool, and we can look to target sell liquidity relevant to 4 standard deviations, right? So here here's a unique scenario where we don't have one relevant to 4. We have one a bit above and a bit below. But what we end up doing here is dropping down and forming and engineering actually a target relevant to 4 standard deviations, which is right here. So we engineer our target relevant to 4 standard deviations and then sweep it before we react and start pushing back upwards and price begins to rally, right? So for an intermediate term trade, once again, we're looking to target 2 to 2.5. So if you were scalping, you were taking profits here. And if you wanted to hold this and take the most out of the trade, you would wait for liquidity to be engineered relevant to 4 standard deviations and then take profit right here. So a trade like that would look something like this. Taking a turtle soup entry, and targeting 4 standard deviations. Taking a quick partial here, waiting for liquidity to be engineered, and then taking our final profits here. Alright, I hope this helps you guys understand how to use standard deviations to pick targets. Once again, for intermediate term trades, we're looking to target 2 to 2.5 standard deviations, and for long-term trades, we're looking to target 4 standard deviations, right? The safest bet is usually to go with 2 to 2.5 standard deviations, because price does not always reach 4 standard deviations. This is extremely useful when picking targets because it can accurately show you where price is going to go and how far price is going to go. Once again, we anchor our Fibonacci from the long-term high or long-term low to the intermediate-term low or intermediate-term high. As you can see, on both sides it works. And I hope you guys have learned something from this video, and I'll see you in the next one. Peace.